This line represents the 2% inflation target of all major central banks. It's easy to forget that actually before the pandemic, most major central banks struggled to get inflation above this line. But now, following lockdowns, unprecedented US stimulus, and a war in Ukraine, inflation is now far above that target. It's at 8.6% in the US, 8.1% in the Eurozone, and a whopping 9% in the United Kingdom. So central bankers have now basically said enough is enough, or as US Federal Reserve Chairman Jerome Powell so passionately put it,
"It is essential that we bring inflation down."
And with surprising confidence he added,
"We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses."
But is that true? I mean, they first couldn't get inflation above target and now it's way too far above target. In other words, do central bankers actually have the tools to control the prices set by millions of households interacting with millions of firms? Well, to answer that question, let's have a look at these supposedly so powerful central bank tools and how central bankers think that these can be used to crush inflation in our super decentralized economies. Okay, central banks plan to crush inflation with not just one, not two, but three main tools. The first tool is the interest rate that they charge banks.
Today, the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point.
This is the traditional and most well-known tool of monetary policy. With raising the policy interest rate, Mr. Powell means that he's raising both the interest rate which the Fed charges banks that borrow reserves from them and the interest rate which the Fed pays to banks that deposit reserves with them. This typically means that banks will now also start charging higher rates to their borrowers and to the savers which deposit funds with them. The second tool is basically telling us what central banks intend to do with their interest rate in the future.
And anticipates that ongoing increases in that rate will be appropriate.
And to make it even more precise, Mr. Powell then told us that
the appropriate level of the federal funds rate is 3.4% at the end of this year.
In central bank jargon, telling us what interest rates will likely be is called forward guidance. This is a really powerful tool that you rarely hear about, probably because it's a little bit complicated, but it's one that central banks think is super important. After all, the worth of stocks and bonds now comes from what profits they will likely generate in the future. So it makes sense that financial markets don't just react to what interest rates do today, but also what they will likely do in the future. Now I know this whole forward guidance thing sounds a bit tricky and therefore it's really easy to just ignore it. But if you do, financial market reactions to central bank announcements will often catch you off guard. For example, after this specific announcement by Powell, stock markets immediately went up. Now this caught a lot of people off guard because the rate hikes were actually higher than the markets had expected. But what happened is that the pace at which those rate hikes would change in the future was a little bit lower than what markets had expected. Now the third and final tool that the central bank uses to crush inflation is their balance sheet.
In addition, we are continuing the process of significantly reducing the size of our balance sheet.
This would be known as quantitative easing had central banks increased the size of their balance sheet, but now since they are decreasing it, it will be known as quantitative tightening. So central banks are selling some of the assets they hold on their balance sheet. This means that they increase the supply of long-term assets in the economy, which also raises the interest rate on these types of longer-term assets. So in the end, it's really not that complicated. Central bankers plan to crush inflation by raising the bank interest rate now, by indicating that they will raise it more in the future, and by raising long-term rates indirectly through quantitative easing. But then to understand how exactly we get from these increased rates to inflation, we first need to understand how inflation comes about. A question that we will answer after a word from our sponsor. Today's sponsor is Public.com. On Public, members can build a portfolio of fractional assets, from stocks, ETFs, and crypto to soon NFTs, art, and collectibles all in one place. What I love about Public is that it helps people be better investors, which is incredibly important in these turbulent times in the market. They have an interactive community of investors where you can share ideas and get daily insights from millions of investors, creators, and analysts on Public. Given the current market volatility, I found this feature especially useful. Then, when you're ready to invest, they have thousands of stocks, ETFs, and 30 cryptos which you can choose from. This includes Bitcoin, Ethereum, Cardano, Doge, Shiba Inu, and more. Plus, there are no commissions on standard stock trades. On top of that, Public routes trades directly to exchanges rather than to market makers like other investment apps. Now, if that doesn't sound good enough, you'll get a free stock worth between $3,000 and $1,000 when you go to public.com/moneymacro and create a new account. Get started today. Once again, make sure to go to public.com/moneymacro to get a free stock worth between $3,000 and $1,000. Click on the link in the description to see full disclosures. Okay, the way that central bankers think about inflation is that it can either be caused by too much demand or not enough supply. When it comes to global inflation, most central bankers still think that most of it was caused by the massive impact of global lockdowns. On top of that, Russia's invasion of Ukraine has caused massive energy and food supply problems. But central bankers also stress that while inflation is much too high in the US, in the Eurozone, and in the UK, the main drivers of inflation in each of these areas are now quite different. I think that Bank of England Governor Andrew Bailey summarized this view quite nicely when he said,
"The United States is facing what looks like a demand shock."
In all seriousness, what he means by that is that while there has also been a big supply hit in the USA, there has been a particularly big increase in demand in the USA due to stimulus checks. This has created extra purchasing power and hence more demand. This had pushed US inflation above that of Europe initially. However,
The euro area, by contrast, is facing a supply cost shock as it starts with a somewhat weaker domestic labour market, and it's heavily exposed to the rising gas prices.
this loosely translates to inflation in Europe is now also really high because it's really exposed to gas price increases pushed up by the war in Ukraine. He also says that
In the UK, we're seeing elements of both.
So, okay, central bankers are saying that inflation is caused by massive supply chain problems everywhere, by too much demand in the USA, and a too heavy reliance on Russian gas by Europe. In other words, it's not caused by the actions of central banks themselves. And that's actually pretty strange, right? Because if they didn't cause it, then how are they supposed to solve it? In other words, how do changes in interest rates, forward guidance, and the central bank balance sheet impact inflation? As you've seen, an economy consists of millions of firms and households, as well as various types of banks and asset markets. So you might not be surprised to learn that economists have come up with a lot of ways that interest rate increases, forward guidance, and quantitative tightening can influence inflation. But most economists actually agree that increasing interest rates through any of these tools will reduce demand in the economy through the financial sector. After all, even though it's very tempting to simplify matters by saying that central bank money printing leads to money directly into the hands of consumers and therefore increasing demand, that's simply not how the system operates. After all, regular people like you and me simply don't have an account at the central bank. But since most commercial banks do pass through higher rates, central banks can indirectly make borrowing less attractive and hence reduce money created by private banks. What's more, higher interest rates make risky assets relatively less attractive compared to safe ones. Therefore, it will make the price of these risky assets go down.
U.S. stocks fell sharply Thursday, pushing the Dow Jones below 30,000. And with stocks dropping, mortgage rates went the other direction, jumping back up after the Fed raised its key interest rate by 0.75 percentage point in a bid to tamp down high inflation.
Well, that first part of the transmission mechanism indeed seems to be working. But then how are reduced borrowing and decreasing asset prices supposed to reduce the demand for actual goods and services in the economy? Well, high bank rates might mean fewer credit card purchases and thus less demand for goods and services. What's more, it might mean less loans for companies, which might go out of business and fire a lot of their employees. This might then mean that wages are less likely to rise and therefore prices are also less likely to rise. What's more, lower asset prices mean that people will feel poorer. And that might in turn mean that they will spend less money on goods and services. Also, lower stock valuations could mean that companies are less willing to invest and thus hire less people.
Potential layoffs at some large tech companies. The latest being Tesla. Reuters reporting that Elon Musk is warning that the company will have to cut about 10%. That's about 100,000 or so employees at that company.
Well, that second part of the transmission mechanism also seems to be working. Finally, central bankers believe that it might be possible that expectations about inflation actually cause inflation without doing anything to supply or demand directly. You see, if firms expect inflation in the future, they might already start raising their prices today. And if workers expect inflation, they might demand to be compensated in advance. And by acting firmly now, the central bank hopes to temper those expectations. Now, it's important to know that precisely because the economy is so complex and data about behavior is difficult to capture, there's no scientific consensus on which of these channels is most important. Still, most economists agree that raising interest rates, communicating about higher interest rates in the future, and quantitative tightening will lower demand and therefore reduce inflation. So it's clear that in a decentralized economy such as the one that we live in, central banks are not fully in control of inflation. So they have to rely on three main tools to make lending less attractive and to reduce asset prices, and then hope that this reduces demand. Or if you want to put it in a somewhat more controversial manner, they hope to make people poorer and get them fired. This has led some people to rightfully criticize central banks for manufacturing a recession. But I do think that economists are right to point out that there is genuinely a scenario in which the central banks have now tightened all of these tools by just the right amount to reduce demand, such that inflation falls much more than actual spending and that the economy is no longer overheating. Or if that's not realistic, maybe they pushed it a little bit too far now, but then when they notice that, they will reverse course and do the exact opposite. In such a scenario, demand will decrease and some people will lose their jobs, but because the labor market was too tight, they will be able to find a new job, and the effect is mostly that inflation will decrease more. Therefore, people will be better off on average. An economist would then maybe say that while their income is a little bit lower, inflation is a lot lower, and therefore their real income is higher. But with sky-high asset prices everywhere, and a lot of that being built on mountains of mostly private debt, that will be a very difficult balancing act to get right. Sadly, given its complexity, the future in macroeconomics is just always uncertain, making it even more important to subscribe to the channel to make sure that you keep up with the latest developments. Or if you want to discuss this and other issues in a small Discord server with me and others, consider becoming a patron or member of Money and Macro using the links in the description. Finally, if you want a deeper dive into all of the potential causes of inflation, then check out this video over here. Or if you want a deeper dive into why really quantitative easing was not to blame for inflation in the first place, check out this video over here.